Welcome to the John B. Levy Company podcast. I'm your host, Rick Young. We're talking now with partner Andy Little. Andy, welcome.
Good to see you, Rick.
Well, Andy, we had quite a first quarter, quite a few bumps.
No doubt, we had all kinds of things to worry about between Portugal and Libya and oil and the various things in Japan. I think there was a lot of problems out there that could have really impacted commercial real estate. What's amazing is really the lack of volatility.
Well, what kind of financial trends are you starting to see emerge?
Well, interestingly, in the CMBS world, which is a great benchmark to sort of track how things are going in finance, we're really seeing three trends that have emerged and are encouraging. The first would be pricing. Pricing has come in quite a bit. As you know, conduits pull together loans and then they'll sell them as bonds. Well, we've seen AAA bonds trading down. AAA bonds in December and October were trading in the 140 range, now at 125. And in March, they got as low as 100, backed up a little bit with all the problems that we were talking about. BBB bonds, same kind of trend. 400 back in October, now down to 300. So very good.
What about leverage?
Leverage is creeping up. I think that'd be the best description. We actually went back and looked at the CMBS deals that were offered in the last 12 months. In the last three quarters of 2010, the average leverage, according to the agencies which rate the bonds, was about 79%. You go forward to 2011, we've had about $8 billion in the first quarter. And those same agencies are saying that LTV now is 89%. Now that doesn't mean a borrower can get 79 or 89% LTVs. That just is indicative of the trend. We're definitely seeing more money coming out of the conduits. The last trend that we're seeing, at least in the CMBS world, is with structure. Interest-only loans, which a lot of people blamed for sort of the car wrecking, going off the cliff. Interest-only loans are back, and they're back significantly. A full 24% of the loans that were offered through conduit lenders in the first quarter of 2011 had some sort of interest-only period.
There's been a lot of discussion about Fannie Mae and Freddie Mac in D.C. What about the future of these two institutions?
Well, Fannie and Freddie it's a topic that is a political football, mostly because of its relation to single-family housing. And there is no difference now between Fannie and Freddie and the government. It's just the government. So the discussion seems to revolve around how are we going to shrink Fannie and Freddie? How are we going to get out of subsidizing loans for single-family purchases? Well, the problem on our side for multifamily borrowers is that we're tied to that whole discussion. And we definitely think that Fannie and Freddie are going to be shrinking, not growing, in the next 3 to 5 years. And that has some implications for multifamily borrowers. The good news for multifamily borrowers is that life insurance companies are out there and ready to lend on multifamily properties. We have seen in the first quarter of 2011 where life insurance companies actually are pricing more aggressively than Fannie and Freddie and really offering more in the way of proceeds. So whereas if you pull Fannie and Freddie out of the single-family market, pretty disastrous impact, I think in the multifamily market.
Where do you see rates trending through the remainder of the year?
It's a good question, and what we like to say is rates are going to change. That doesn't help you very much, but they will. We really have no crystal ball. I think if you look at the yield curve, that's a pretty good indication. It's very steep right now. It's been very steep for some time, 6 or 9 months. I think that the steepness of that yield curve tells us that rates are going to be moving upward.
All right. Andy, thanks a lot.
Thank you, Rick.
For more information, give us a call at 804-644-2000.